Hello and welcome to Market Matters presented by Mike's. I'm Joe Teagay. Welcome everybody, and with me as always is Brian Stutland. Say hi, Brian.
Hey, how you doing, Joe? Good week. We're off to a good start, hot start. Kind of interesting stuff going on in the market with our big mama stocks, what I like to call Microsoft, Amazon, Meta, and Alphabet, all kind of down with lots of other names up on the day. So lots to talk about here.
Yeah, interesting week. A very busy week. We'll get into that. But before we get started, do you have a good weekend?
Yeah, I mean, especially good since my squad, the Bears, beat your Lions on Sunday and looking like we could potentially make a playoff run. But I'm not a sports analyst. I'm here more to talk about the markets.
Yeah. We went to that game. I was in Chicago. It was a double whammy for me because I could have took your tickets and sat in a nice seat. And I went with my friends, decided to spend extra money to sit in a not nice seat and watch my Lions get smoked. So we'll work on things going better this week as we get going. But we got a fun week, a really busy week for news, and should be great for options traders. So I'm really looking into it. So let's dive into it with our weekly preview. We got a lot of economic reports, like I was mentioning here. We got the CPI that's been a huge market mover for the past year and a half. We got the PPI, another potential market mover. The big thing we have, of course, is the Fed policy decision. That's always interesting. And how is Powell going to have that press conference? What's going to be the new key language in there? And then finally, we got some retail sales coming on Thursday. So there is a lot for options traders to look through here. And as far as earnings goes, we got not as much this week. It is we're winding down the year here in earnings, so we don't have as much going on. Oracle might be a little bit interesting today after the close. But the big one for me, we're looking at later, will be Costco. Can't wait to see their results. I've been a huge Costco fan, so it'll be interesting to see how we trade that going forward. And what we always do to start the week, just to look at the sentiment, consumer sentiment, is something we follow just to see how bullish, how bearish is the market. It can be a contrarian indicator. Last week, we were kind of dipping our toes into maybe over bullish narrative, but we had another positive week, slightly positive week last week. So we dipping back just a little bit isn't telling me too much here. There's maybe more room in the tank here for the bulls, but again, we are very, very bullish on this chart. So looking forward here. We're seeing a lot of talk. We know this has all led the spike index to be relatively low. The spike index is usually low in December. We're right about 13 and some change right now. So that is super low. And we're actually getting some reports out there. We're seeing JP Morgan saying 2024 is going to be a higher volatility year than 2023. I mean, it's easy to see volatility going up from 13. Yeah, but they're saying that the spike index averaged 17 for 2023. So they're going to say a higher than 17 average for 2024. And you know what? That kind of makes sense. It's an election year. We've been talking about that. Seasonality plays into it. It is higher volatility in election years. Also, you got the end of the Fed cycle. If we do get an economic slowdown, we should expect to see volatility rise. But again, the actual economic data has to slow down before that happens. So that is interesting to see. But there are some people saying that, there's a different reason why volatility is so low. And Brian, I wanted to show you this. I think this is really interesting for all of our users out there. So we're seeing a lot of new ETFs out there, a new trade, a big fad out there really is these short volatility ETFs, these short volatility funds out there that give people new access to the market, be able to collect some premiums, collect some yield using options by selling volatility. So it's really, really interesting here. And Brian, have you noticed this trend? Have you been aware of this like I have?
Yeah, I mean, when you look at this chart here and you see the increase in AUM, assets under management, in these ETFs that are supposedly trying to collect income, and they're using options to do that. And so what does that mean? It means that people are selling insurance, similar to insurance, let's say, on your house, hoping that your house doesn't burn down and that they can collect premium on the market with some level of exposure still to the downside typically. Not every one of these ETFs give you full hard protection, as we like to call it, all the way to the downside past some point. It's typically there's some sort of premium being taken in, and in return, looking for other parts of this market to sort of add yield and enhancement beyond just, let's call it, your typical high yield bonds or other ways to play some sort of income producing strategy. So the downfall here is, you mentioned Volmageddon. We saw that on our list, Volmageddon 2.0. What does that really mean? Well,
let me step in here, Brian. Let me go for you. Okay, so everyone's asking, how is this going to be volatile? What was Volmageddon? Well, this is just for people who weren't trading back then. Volmageddon was the name given to the event that occurred February 5th, 2018. So remember the 5th of February. That was a critical day in 2018. That was the day when we saw volatility surge. So we saw the CBOE VIX futures rise. It was a really fascinating event. It was kind of like a short squeeze into a stop limit order. We had the futures up 20% throughout the day. Then in the last minute, surging to up over a whopping 120%. So it was a rapid increase in the value of these futures in just the last hour of the day, which really sent shockwaves throughout the whole volatility space. It led to like the unwinding of a lot of these popular trades, like the SVIX and these really popular leveraged short VIX, short volatility trades. So, and you and I, we had a front row seat to this.
We did.
It was one of the most unpredictable events of our trading career. That's in even the history of the stock market. As an experienced investor that's seen our share of fluctuations, like this was different. This was an enormous move, and it was just a reminder that anything can happen at any time, no matter how well you're prepared. And it's also just kind of a textbook case of the need for diversification when it comes to volatility futures and volatility space. So the introduction of the spike index is really critical to that area.
Yeah, and one thing to keep in mind here is we look to trade this ourselves for clients and our own trading. When you look at all the ETFs, we talked about that, and the level of income they are trying to collect, there actually looks like there is some opportunity now to take the opposite side of the trade. Anything that sort of gets too bubbly and frothy, we like to then sort of take the other way around it, which is owning some optionality in the market and playing the level of volatility that could occur. We have the Fed backstop not in play as much as it once was. Let's call it, 2009 through those 10 years to follow. And the market's really changed in a dynamic where we've seen now 2 greater than 20% drops in the market in just the last 5 years. So we're trying to play that a little differently and take the other side of the trade.
Yeah. So historically, people like buying before this trend, people liked buying options for protection. This is a new trend of selling options to collect some yield. So does this trend to you say a Volmageddon 2.0, Volmageddon is about to happen again?
Well, I think possibly if we could maybe dive into the charts on the S&P 500, I think we'd be able to see, is this Volmageddon coming sooner rather than later? Now, the spikes index sitting here around just below this, around this, hovering this 13 level or so, is on a historical kind of low when you look back. So, it is poised to get this sort of spike up higher and catch people off guard. Now, will that happen? I'm not so certain, but we are seeing some dynamics in the market where the S&P is sort of reaching some critical levels where it could typically break significantly higher or also fail to make that breakout and get people way off sides and then cause this Volmageddon 2.0. I'm not so certain 2.0 happens just yet. Typically, we see spikes no more in the high teens and 20s first, settling in at that range and then moving significantly higher, rather coming off these very low levels, as we mentioned before in last week's show.
Yeah, so for me, the 1.0 had to do with some leverage, some short positions that had to be stopped out at a certain point. I'm not so sure this is the same case with this current version of short volatility. We'll have to wait and see. Some of those funds there might be some skittish investors who might want to pull their money out when the market's down. That might cause like a run for the exits all at the same time on this short vol turning into long vol. So that's one possibility. But for me, that isn't quite necessarily apples to apples, but it could cause when the market does hit a low, when the volatility does spike, it could cause for some interesting trading. And we should really see some fireworks when that does happen. But anyways, as you mentioned, let's get on with it. Let's go onto our 2024 preview, which leads into this trade. So we had this narrative where, like I said, people typically use options for protection. Now they're using options to collect some income. That kind of changes the game and kind of changes how options traders like us look at the market, because volatility, is a little bit different. Brian, what are you seeing here?
Yeah, this is an interesting chart you bring up here, and I got to trade off of this, because when you look at the market, it's made what we like to call sort of this head and shoulders bottom, where you get what seems to be a market that's making lower lows, and all of a sudden we have this reversal now, and we're seeing higher lows, and now we're sort of breaking through this neckline at the 4,600 mark in the S&P 500 index. When you look at that, it looks like we're starting to break through and break out of it. So typically what I like to do is look at sort of stock replacement ways, or ways to own options to play this potential breakout, because I think one of two things happen into 2024 is, one, we get a breakout above this 4,600 level, or two, it starts to break out to start the year, and all of a sudden everybody is trying to pile in that trade, and then there's a reversal and people try and back out of that, and all of a sudden this could create some significant selling. Because when I look at sort of this neckline, 4,600 all the way down to 3,500, typically when we fail this kind of breakout, it goes and retests the lows. So there's some risks to the downside here. And I think using a long options position to play this kind of gets into like a market update. A few weeks ago, I laid out a SPY trade of buying a call. It's now significantly in the money. So I'm looking to roll this call and put on a slightly different trade, still using call options, but I'm going to sell out of that call that I once had. Or if I was long the market, let's say I would sell out of my stock position. And I'm looking to sort of keep that delta exposure by buying 2 at the money calls. And I'm looking at the SPY March 467 calls. I can pay about $10.65. That's where they were trading a couple hours ago. And then that way, I think option premium is so low here. Think about it. This is about a under 4%, about 3% of the value of the SPY. So I'm going to pay that twice. I risk about 6%. I get double the upside now through that break even of, call it 477.65. And then on the downside, I'm only risking the premium I've paid on these calls. So that in itself kind of gives me a protection as a way to sort of replace something I once had that has become 100 delta to the market, like we say, or it has full exposure to the market. I can kind of take that risk away, only risk the premium of the call. Joe,
right. I love this. I love this trade. You're buying 2 calls that gives you 250 delta calls, that gives you the 100 deltas. It gives you that, 1-to-1 move like stock does. If you got some questions about this trade, we're going to have some education on the stock replacement later in the show. So stay tuned throughout the show. But yeah, that's what we're looking at here. We're looking at 2 calls, which gives us the same delta as stock, right?
Yeah. And so this is just a smarter way, risk less, to potentially make more if we can get up through that break-even side. Like I said, I think that neckline, 4,600 down to 3,500, the target for me then puts this market, the S&P, north of 5,500. So we could be in for a significant move that would put the SPY above, call it 550. So anyways, Joe, moving on in the show here, next up, obviously we see ways where we can use options that we feel are trading for a cheap premium level. We have earnings coming up. Is there a way to play Costco? Obviously, that's the big name on the move. That thing has been moving to the upside. Are you jumping in and buying this stock right now, or are you trading this differently?
It is showing a lot of strength. And if you've just looked at Costco in the last week or so, you'll see this gap higher, this tremendous gap up higher to all-time highs. If I'm looking at this to initiate a position, buying Costco right here, I'm a little squeamish. I'm looking at this chart, and it's just racing higher. It's like the reverse of catching a falling knife, or just continuing to buy this thing on the way up. It makes sense for a pullback. And really, I put the relative strength index here on the bottom, this chart, underneath the chart, underneath the volume here, there's this relative strength index, and you can see when it gets a little overbought, it gets red here in this relative strength index, and that sometimes can be a sign that it's a little frothy, a little top heavy. So that's right where we're getting to now. So that that might lead me to think, hey, this has come too far too fast. But if you go back in history, there have been other times where we've seen this relative strength index a little overbought, and really it's done quite well in those periods. If you know anything about Costco's chart, you'll know that the long-term pattern is fantastic. And you can see here we had this overbought situation, but wow, did Costco really accelerate through that? They just kept on buying it, even though the relative strength index was showing overbought. And that's because this is how it looks all the time. It's just this parabolic upward move. Now, what reminds me of the last time we had this relative strength index overbought, where we saw that nice run, was it again made a new all-time high after a steep pullback. So we had that recovery here, made this new all-time high. We got overbought, but we continued to run. That looks similar to me like we're seeing right now. So yes, it is very risky to jump in here buying Costco at $625, considering it was just recently $550. Yes, but initiating a new position, Brian, we own Costco for our clients, so we're really happy about this move. But initiating a new position, I think for myself, it's better to do so with options. I would just look at another stock replacement strategy. I will be buying the December quarterly 625, 650 call spread for 860, like a 1.25% risk of the total premium of Costco. We know earnings can be volatile. We know earnings they can move 4 or 5%. Costco typically has earnings moves that are smaller than that. But we know that on a miss or guidance that's poorly, we know there can be a downgrade. So I'm risking less potentially on the stock and still going to capture this upside, still going to play to the upside if we do continue on this strength that it's just been showing tremendous bull run lately.
Yeah, and I like the trade, like we mentioned, in these stock replacement kind of strategies when options are cheap or the stock has made a significant run. So you kind of are in a place where it's like, oh, should I jump in and buy this stock and ride the wave higher? If I do, am I going to be caught, off sides? And then it's kind of like buy the rumor, sell the news after earnings. So instead here, Joe is using a call spread to sort of risk less, but still get more upside should the stock continue to run. So I really like that trade in that sense. And break even 633.60. That's where you'd want to see the stock get above that level to break through the break even on the call spread. Below there, you'd lose money, but your only loss total if the stock were to go down is at $8.60.
Yeah, and again, this is what we're looking at. The implied market maker moves 2.5%. That's not very expensive volatility when I'm looking at these earnings. If I were looking at this and it was showing really expensive volatility, I'd flip it around. I'd want to sell a put. I'd be looking at collecting premiums, making money on volatility coming down, and maybe also being prepared to buy the stock should it go lower. All right, so flipping it around, let's move it on to the question of the day. Looking through, I don't see any questions at the moment. Remember, if you're watching the show right now, ask us a question in the comments. We'll answer it next week on Twitter. Shoot us a tweet at Brian Stutland, at Joe Teague. Happy to answer any of your questions. That's what we're here for. We're here for the educational value always. But so let's move it on to our final segment. Let's see if we can bring out Trader STS.
Yeah, let's do that. I gotta get my trader jacket on to sort of give people a little heads up about. We like to try and use the show to sort of teach people about option trading and how we look at the market and how to use that so that you're not just leveraged and losing money, because option trading can be a little tricky. So got my little old school trader badge on here, and let's put the trader hat on and see what we can do.
All right, I can hear some brokers cribbling or trembling with fear when they see that badge.
Yeah, right.
Okay,
and they should be. I'm a dangerous guy,
Options 101. How do you use call options to replace stock?
Yeah, I think this is an interesting strategy because it's exciting to use a call option. When you're looking at long stock, you basically get a 1-to-1 payout, right? The stock goes up $1 for one share, you make $1, vice versa to the downside. And so when you look to replace that, it's kind of an exciting strategy because instead I'm going to use a call option, which is going to echo the same sentiment as long a stock, but I don't have all the downside. Now, here's the drawback. I do have to pay a premium, and I have a strike price to which the stock needs to get above for me to exercise my right, and it's got to get above that break-even level, as you see, the cost of the call option before I start making that one-to-one payout like I would a stock. Now, I can also use this call option to not only replace a stock position where I'm a little fearful of what the market is doing, but when I feel like these call options are cheap enough, I may use 2 call options instead of 1, because each call option at the money is what we call 50 deltas. And so multiplied by 2, 100 deltas, you get the same one-to-one movement in the call option as you would movement in the stock price. But here's the drawback. Now I've paid more premium, so my break even is shifted, and I need more upside for this to pay out, but I get to make more with risking just the call option premium should we get through the break even. So I like this strategy as a stock replacement kind of strategy.
Awesome. That was Options 101, how you use call options to replace stock. That makes a lot of sense to me. That is very useful. Delta wise, it's the same risk on a percentage move of the stock. So that's how it's done.
All right. Well, this has been a great show, Joe. Again, we brought a lot to you. We talked about the markets and the S&P breakout, Costco earnings. That should be fun to watch. And then obviously CPI, PPI, Fed decisions, lots to digest in the market as we hit into quadruple witching, as they like to say, the third Friday of a quarterly expiration. So should be a lot of fun. This is Brian Stutland, Equity Armor Investments. I was here with Joe Tigay. Market Matters. Tune in every week. This show is sponsored by the MIAX. We'd like to thank you for that. And we'll see you next week.
Have a good one.